Hello, everyone, to this fresh podcast of the Stoic Talks series. The podcast is presented to you in collaboration with DSP Mutual Fund. Our today's guest is Mr. Prabhakar Kudva, co-founder director at Samvitti Capital. Prabhakar has a varied experience in different fields, from software to financial technology products to investing other people's money today. He writes a popular blog, Investment Insight India, where he presents a lot of interesting ideas as well as thoughts on a regular basis. He was also selected among 40 under 40 investment managers by Association of International Wealth Management of India. He has been cherry picking stocks and giving market beating returns for the last many years. So it would be an interesting conversation. Do tune in.
Okay, great. Welcome, Prabhakar. Great to have you today. I have been wanting to talk to you in this format for a long period of time. I think last time also we had a conversation around this, but didn't materialize. So good to have you. I've been uh, actually I've really enjoyed consuming the content you put for two reasons. One, I think very few people venture outside the defined boundaries of their investment frameworks and investment world, and you are one who have consistently done that, and that's always appreciated. And secondly, of course, your performance have been good. You have been doing managing money, so there is a more practical aspect to money management rather than just theoretical concepts. So would be great to pick your mind. Welcome to Stoic Talks.
Thank you so much, Puneet. Thank you, Nuresh. It's a welcome change to actually talk to practitioners, rather than so all the other interviews I've done, it's mostly people who are just starting out in the markets who want to learn more about markets. But you guys are hardcore practitioners, so I'm sure we'll all have fun.
Sure, perfect. Yeah, I really hope that. Let's do one thing. I as I was telling you before, that also our main attempt is going to we will guide all the listeners to your old videos or interviews or things which you have said in public, and we will build over that so that we can give a bit more detailed nuances to your working. Most of the time I start with stock picking because that's ultimately the bread and butter, and you have said a lot on stock pickings. But today I thought that I will probably start with one question which I usually take at the end, which you haven't said much about, and which makes or breaks the portfolio processes. And that actually comes from allocation of the stocks, right? So you haven't really discussed a lot on allocations. And while I start with this very broad question on allocations, I also want you to now give me your journey in terms of your understanding on allocation, and then I'll move to stocks because I have been following you from the very start. You have been in the market for about 15 plus years, if I remember correctly. And I have read few articles where your allocation methodology have also evolved over a period of time. So maybe you can combine your journey in the markets and your allocation strategies, how they have evolved over a period of time, as first question, which is very very uh, first time we're doing that. So let's give it a shot.
Sure, sure. So, I mean, let me start from the beginning. So, I was actually very fortunate, to be introduced to the markets at a very young age. So, I was introduced to the market, when I was in my 10th standard, so around I was 16 or 17 years old. And it was actually my dad, is a banker. And, so actually I've spent a lot of time in the northern India, Allahabad, Moradabad, Delhi. So, most of the, my growing up years were in Delhi, and every vacation we used to sort of come to Mangalore, which is my native place. And my uncle at that time was one of the few people who was actually in the stock markets, and he had a computer. This is about 15, 20 years back. And he used to make me sit next to him, and I think Nuresh will relate a lot to this. I used to look at the charts, and that was my very early introduction to the market. And very quickly I sort of realized two things about markets, right? So that one is that it's a meritocracy, and the second, that it is an opportunity machine, right? So I'll put that in context, right? So for every middle class young boy, the path to success is through education in India, right? So you ace your entrances, you get into the IITs and the IIMs, and so that's the typical path. But once I got that flavor of the market, I somehow at that young age I realized that this is it. that I'm an introvert, right? So I am, I don't really like socializing a lot and all of that. So I, this was something which was God sent, because I feel that market is a single player game. It's between you and the market. You look at your charts, you do the studying, you do all of that, and there is no hierarchy. If you're good, you're good. In any given year, if you really have the skill sets, then you can beat the best of the players. So that is how I sort of started, and I gave a lot of attention to the markets. My parallel life continued, whereby I did my schooling, and as usual, I did my engineering, so I'm a computer science engineer. I studied engineering, and but all this while, the one thing that was common was, I was relentlessly involved with the markets. I read hundreds of books. I spent a lot of time on the internet, a lot of forums, a lot of content that I consumed, and that is what the aggregation of all of that is what shaped me as an investor. So I have literally learned from scratch with no theoretical business background, right? So why I'm telling all this is because over these years I've got an opportunity to try different styles of investing. I'll come to your question, which is a segue into that. Basically, is that when I started out, I was the most concentrated investor you could find, because there cannot be any more concentration than what I did, because for a long time, in my initial years, I just owned one stock. I was famous or infamous for that on a couple of online forums, that there was just one stock that I owned in my portfolio. All of my whatever little net worth was there at that point in time was in Hawkins. All of my money was there, and from there, over a period of time, as the capital grew, I realized that diversification is actually not such a bad thing. Diversification gives you not only more than the protection, diversification gives you optionality. Because I remember 2012, 13 to 2016, 17, I participated in that bull run, and we made good money. But there were a lot of stocks, like Symphony, Astral, all of those, stocks which were very small at that point in time. Your Avanti Feeds, all of these stocks I had seen, but because I had this notion that I am a concentrated investor, I stuck to my Hawkins and Page, which also did well. But I could have done, if I had a bunch of these stocks, all of which I had seen and understood, analyzed, I could have probably done much better. So the biggest takeaway that I got is, other than the usual risk management, that comes into play when we diversify, it is the optionality. Because most of the times, the stock that does the best is a surprise. Most of the times, if you ask me, pick 5 stocks and rank them in terms of my expected returns, for most investors, the stock that will turn out to be the best performer will be a surprise. So that optionality is what diversification brings. But then, as I grew even more, see, I really wanted to understand how the market works. At some point, I wanted to go deep. I didn't want to be a value investor or a growth investor or a concentrated investor or a diversified investor. I really wanted to go deep. My question always was, I want to understand what makes the market work. What makes the prices go up, what makes the prices go down. And as I have matured now, I have actually come to the realization that your portfolio structure, the portfolio construct is actually a function of your setup. I've realized, I've written recently, a bit about this, but the idea of having, one or two setups that you master, right? And the portfolio construction becoming an offshoot of that is a much more natural progression, than how most investors start. Most investors start with labels. They say, I am this and I am that, but your setup is what should define your portfolio construct, and your setup itself is derived from certain structural tendencies that happen again and again in the market. So I'm sure we'll talk about that a bit later, but my final conclusion, as it stands today, is that portfolio allocation and portfolio construction is not something you start with, but it is an outcome of what path you decide to take in the market.
Yeah. So actually, now I can take the liberty of clarifying why I started with allocation first, and maybe delve a bit more into that. Right. Uh,
Yes.
the more I have seen, and I've seen your journey going from a concentrated one stock investor to an investor who has talked a lot about different kind of patterns which you see in the market, and patterns eventually lead to selection of stocks. Within that, and I will come to selection stocks later, but within that you have different kind of buckets you have discussed over a period of time. Some were quality and buy and hold, and some opportunistic, and so on and so forth. I'll come to that later. uh, and then just now you also said that it's a matter of your setup, and it is also a surprise. Usually the best performing stocks are a surprise. Okay. Now, if I want to ask you the question on allocation, what I want to basically get into, and then we can probably make a parallel of the stock selection also, is that how do you, given that your understanding is that most of the stocks don't end up generating the returns you want them to, or you hope or you think that they will give that kind of returns, and as you said, winners are surprise. uh, how do you marry the thought that conviction should lead to higher allocation, and lesser conviction allocation should be a decision of your conviction, given that there is a randomization in terms of your returns? So is there a thought you have on that? How do you marry these two separate, seemingly separate principles, so to speak?
No, I think I think conviction. This is so. I had very different thoughts about all this, a few years back, and as I've really spent time thinking about it, no, I think conviction. The idea of conviction itself is, is a bit, arrogant, so to speak. Because see, conviction is something, is that you believe that you are right, and sometimes having a lot of conviction can lead to a lot of biases creeping in, right? It can prevent you from doing the right thing at the right time, right? Uh, so when we say I have a lot of conviction, we typically end up with saying over allocating to something like that. So I'll give you an example, right? So Bajaj Finance, right? So conviction. So this was something I was very, very convinced about. Okay. And I did, make good money in it, right? But come COVID, right? What happened is I was over allocated, right? Because conviction, right? So I was convinced of the management. I was convinced of, but what happens is when you are, over allocated to something and you strongly, believe in, a particular thesis, and when something goes wrong, you become like a deer in headlights kind of a situation, right? Because you thought in one direction, right? And things are not turning out that way, so you are not able to decide when you should decide to do something about it. And at the worst possible time, you will take some decision which you will regret, right? So this was one instance where I realized that with a lower allocation you can actually make more absolute money than a higher allocation, right? Which is mathematically sounds absurd, but what happens with a higher allocation is the market forces your hand at exactly the wrong time. See, if you own 15% of your portfolio in Bajaj Finance versus if you own, let's say, 4 or 5%, the 4 or 5% of the portfolio, you can take a 50%, drawdown or 60% drawdown. But with a 15% portfolio, what will end up happening is when the stock is down 50%, and most good stocks in the Indian markets have fallen 50% time and again, right? You will end up doing something stupid, and you will sell it at exactly the wrong time, or you will reduce your allocation at exactly the wrong time, and you will actually end up making less money, right? I think the biggest opinion about this was from Charlie Munger, right? He said always keep looking for disconfirming evidence, right? Always look for something that is against your thesis. So this idea of conviction, the way we look at it, right? Conviction and marrying conviction and allocation, I think is fraught with a lot of risks over a long period of time. It might work very well in a bull market, but when you are evaluating this thesis across a cycle, across a 2008, across a COVID, across a demonetization, across all of these things, the idea of conviction becomes I think it's on a shaky ground, is what I have understood over these years.
Hmm. Okay. So given this brief background, now let's shift focus to your actual portfolio construction,
Yes.
from stock selection to the risk management part, at a more practical level. So now, when you are starting, and again, borrowing from what you have already said in past, um, you have invested into, and you do invest into, the so-called high quality names, resilient businesses which have shown resilience over a cycle. And in one of your interviews you have said that that is a good chunk of your portfolio. um, I mean, but I think, and you can correct me if I'm wrong, you are conscious on the valuation front there. Is that a fair understanding? And if is that a good part of your portfolio? Let's start with that bucket first.
Yeah. So so the portfolio is basically divided into two different baskets, right? So one of the baskets is what you spoke about, the quality basket, or the basket which you can buy and hold, and that there is some secular tailwind behind these companies, so the earnings will keep on compounding. The risk is on the the multiple, which can compress or expand, right? And the second part of the portfolio, which is slightly more aggressive, is more of what I call, which is on the back of the the PEAT phenomenon, right? So earnings surprise. So earnings surprise works phenomenally well, across markets. It is a structural tendency, across all markets, not just India. And this is typically a 2-3 quarter kind of a play, where you can generate reasonably good alpha if you can pick businesses which are showing some sort of a sudden earnings surprise. And you can if you can estimate and figure out if this earnings momentum can continue for the next 2-3 quarters, then you can make good alpha. Of course, you should know when to get out, and but this is a a 2-3 4 quarter play, right? So these are the two buckets in which I generally divide the portfolio. Which is one of the other things which I have realized lately. An insight is that there are two ways to operate in the market, right? So the first is, you have to be either very passive to make money. Two ways to make money, essentially: either be very passive or be very active. If you are anywhere in the middle, right, the middle path, in my opinion, generally does not work, right? So either you are the kind of investor who is doing an SIP into index funds, doing it in a disciplined way, you're not bothering about it, you will make good returns. Or you are a Warren Buffett type of investor, taking one or two decisions a year, very passive in nature, you will do well, right? Or if you are a person who is into the markets, spending a lot of time in front of the screen, spending a lot of time watching the markets, and analyzing the trends. So you have to be very active. So a lot of retail investors, I feel, are somewhere in the middle. They want to be traders, but they don't have the time. So they are not able to be active, but they get into the kind of stocks which need active management. So what I mean is, so these two buckets that I've created, right? So essentially, the first bucket is supposed to be a passive bucket. And the first bucket is where you are taking a 3 to 5 year kind of a bet, and you know that the earnings will compound at 15 to 18% CAGR. And if the growth runway is long enough, then the P's generally don't compress, right? So something like DMart, right? So DMart has been expensive from the day it got listed, and it has only gotten more expensive, right? Now, the reason for that is, you know, d- uh, 70 to 80% of the GDP is retail, right? And if you look at something like how Walmart has expanded in the US, there is a huge growth runway for DMart, and that is what the market is pricing. The market does not want to give you free money, and that is why the PE is so high. Because even if the PE compresses and DMart is able to grow at 15-20% CAGR for the next 10-15 years, and let us say the PE compresses, you will still end up making 8 to 12% CAGR. That is what the market will give you even post PE compression. So an expanded PE for a long time means that the market is very sure about the earnings and the runway. And the other type of stocks, which I said are, earnings surprise kind of stocks, or some sort of thematic bets that, I keep taking from time to time. Uh, those are the stocks where you need to be active. There you cannot get carried away, and you cannot confuse yourselves between these two baskets. And that is the biggest mistakes investors do, right? They confuse between the bucket one and the bucket two. Bucket one you can afford to average down. You can afford to buy them when they correct. You can buy them during a crisis. You can keep holding on to them, for long periods of time. But the bucket two stocks are where you have to be very nimble, and you have to be willing to cut your losses at times, and you have to be willing to do a lot more churn to generate that alpha.
So, what sort of say allocation you have on bucket one, and what sort of an allocation in bucket two, or it's very dynamic?
No, I prefer everything to be in bucket two, because bucket two is where I feel there is more compounding if you get it right. As a practitioner, right, we are the thrill for us is more in picking the stocks rather than making returns. That may sound controversial, but like I said, sometimes just being very passive also, right? Somebody who just owned a basket of FMCGs in the 90s, made phenomenal amount of money, right? But being involved in the market and being passive does not go. It's very difficult to do that, and very few people can do that. I'm sure there are exceptions to this, but theoretically, I feel the bucket two is where faster compounding can happen if you can do it right, and that is where the alpha is. The alpha is not in buying the 12 to 15% growers, but the alpha is trying to get into those opportunities which can give you 20-25% in a quarter, couple of quarters, right? Of course you will not do that at the portfolio level, but even if you get in a good environment, in a good earning season, in a good market, that is where I would like all my money to be.
So that is where your patterns and everything comes into play. So maybe you could explain one so that all of us can understand the way you look at a 2 quarter or a 4 quarter thing.
Sure.
Your
No,
favorite pattern.
no, before getting into patterns, Naresh, so how do these patterns come about? So let's go one step deeper, right? So there are certain structural tendencies. I did a thread recently about the physics of the market, or something like that. So there are some structural tendencies, that you can observe in the markets, right? Now, this is not any original thought, right? It is all an aggregation of what I have read. So what are these structural tendencies? If I can list down a few, right? So you have momentum, right? Everybody knows momentum. So momentum is a structural tendency. If it works on all time frames. It will work on an intraday time frame. It will work on a day time frame, and different people have different strategies which take advantage of momentum, right? The other structural tendency is mean reversion, right? So mean reversion. So what are value investors doing, right? They're playing mean revert, right? What are cyclical investors doing? They're doing mean revert, right? So mean revert is another structural tendency, right? The third structural tendency is, I would say exhaustion, right? Whenever there is a buyer exhaustion or a seller exhaustion, right, you get a very sharp move to the other side. Now, this is a good, entry point into the idea of over and under ownership, right? Over and under ownership, like what's happening with the PSU banks now, right? It is basically what I call neglect. It's extremely underowned. So when neglect and under ownership meets with some catalysts, you get an explosive combination, right? What's happening with the US tech? Everybody and his brother owns US technology stocks, right? Every second person in India today owns that Motilal Oswal Nasdaq ETF, right? So what exactly is that? It's over ownership. Every institution in the US own the funds. So there is extreme over ownership, and that extreme over ownership will mean that there are no incremental buyers. Everybody who has to buy has already bought, right? So that is a buyer exhaustion, right? So exhaustion is the third structural tendency, right? The fourth one, the structural tendency would be like I said, a surprise event, right? A surprise news, or a surprise earnings, right? Whenever the market finds something new, which is a surprise to it, it re-rates itself on the either side, right? It extrapolates that, and it gets into a re-rating, phase, right? So that is the other one. The next one, I would say is, small cap stocks, right? Smaller market capitalization or smaller float, right, leads to much more bigger moves than you can ever find in large caps. It's a structural tendency. You can see it across markets. So there are several of these, five six structural tendencies, and all the setups that people have are actually an offshoot of this. So you have to, so you can you go back and think about it. So essentially, whatever setups you have, whether you are an investor or a trader, are an offshoot of one or more of these structural tendencies, right? So from from there, all of these other patterns emerge, right? So what exactly is an earning surprise, right? Like I said, so earning surprise is basically an event which has happened, like in a soap opera, right? There is a sudden turn, some event happens, and suddenly the story takes a different turn, right? So it is something like that. Whenever a news comes out or an earnings comes out, there is a tendency of the market to re-rate and and price in this new information, and the pricing in of this information takes time. Now, we are fortunate in India because we have circuit filters. You would have seen in the US, the pricing in of information happens, in a much more crazy way. You will see stocks, the biotech stocks will go up 500%, 800% in one day. But in India, because we have all of these, hundreds of rules, it's actually a good thing for people like us, because market takes its own sweet time to price in that information. So when you get a blockbuster earnings report, the market will take at least a couple of weeks to a couple of quarters to really price that in. And that is where the edge is. That is where, we come in and we say that, okay, now this stock, and the same happened with PSU banks. You look at the results which came out, some of the smaller private banks and all of that. From the day of the result, on the day of the result, you could have said that there is a good 30-40% here, if not more, right? Nobody expected the kind of craziness that followed, but it was very much predictable, and the market does not move 30% in one day, right? So there is there is an edge there. So any other setup, whether it is if you look at I spoke about one of the setups is how the margins mean revert, right? So if you look at some of the tire stocks right now, okay, they're giving out horrible results, okay. All the margins are at multi-year lows, right? And on the other side, we know that the commodity prices have already started falling, and you will see that all the tire stocks are now near 52-week highs, right? And the reason for that is the market is anticipating the margins to start mean reverting. And so there is a trade there. There is money to be, there is some money to be made there, of course, with the usual disclaimers and all of that. But I'm saying mean reversion, in basically cyclical players are doing what? They're doing mean reversion. So if you understand from where your setup is emanating, from what structural tendency, you will be in a much better place to milk that setup. So just following a setup, because I put something out on Twitter, I keep getting a lot of DMs, that can you give me, this, because like I said, you have to make the setup your own, right? So everybody, so you have to master, one or two setups, and you all as practitioners will know that, right? There are a lot of nuances in the market. It's never black and white, that you do XYZ and you will get this output. It is not science, right? So there are a lot of nuances. So the market environment matters. In a bad market environment, nothing will work. So understanding the market environment and making that a part of your setup is also a very important thing. But this journey from understanding a structural tendency and using that to build your setup, and then going about mastering that setup, is where the entire spectrum of an investor should be.
Interesting. So, say, like we say in momentum, the main edge is the fact that people cannot panic on buying. People get
Yes.
panicked, say, when something odd happens. That is how we are structured. So
Yes.
one of the reasons we say momentum really works is because
Yes.
people cannot go say there is no forced buying, right? So on the
Yes.
way down,
Yes.
the broker sells your position, your
Yes.
emotions sell your position, but on the way up, nobody is going to say, "Boss, if you miss it, nobody is going to come and kill you."
Yes. No, and there are some no. See, like I said, no. See, momentum is a very vanilla tendency. Now you have to so just follow just momentum is not an edge, because everybody knows about momentum. So so momentum is a tendency. Now how do you convert this tendency into a setup? Is where the skill really lies. So, for example, you could people you could use momentum to, let us say, uh, create a strategy whereby, what example can I give you? Okay, let me just think about it and come back. But yeah, so what I mean is that, using vanilla momentum, you have to mix momentum with something else, like momentum and low float, right? That is a potent combination. A momentum, in a large cap stock will actually mean revert. So you have to know these nuances. A momentum in a small cap stocks is more likely to continue. A momentum, with a catalyst is more likely to work much better. So people do this, relative ranking of stocks and just, buy them, which also works during a bull market. But if you want to make it an all season thing, then you have to mix momentum with some other tendency, and then, convert that into a setup.
Sure. I'll now try to give a structure to what we have discussed so far, and also then make the question. So far, from a portfolio construct, you're saying two buckets. One bucket is the quality names, which is your not so preferred bucket. You want to be in the second one, which is more timing centric, if I can use that word. Timing centric, lesser short. I mean, it's lesser term holding compared to a buy and hold kind of a strategy, and you're looking for higher returns there because they will be triggered with, I mean, short term boost in the prices because of some factors. um, I had a lot of questions on the first bucket, obvious reasons. But since that is not your preferred bucket, I'll just close that bucket by some very commonsensical discussions, which is mostly the debate around quality stocks. One obvious thing is, I'm guessing that your preference is not there because you certainly feel that the XIRR or the quantum of returns you can make from a buy and hold kind of a thing is lesser. Otherwise, why would you do that? So there must be a belief system that the assumed 25-30% CAGR, which people assume from these kind of names, is a difficult thing to get. In what scenario will this bucket, which is quality bucket, if at all, will be a significant portion of your portfolio? And secondly, how do you go about selecting stocks for this portfolio? What will be your criterias? And thirdly, I will just combine the questions here. Thirdly, how do you manage risk when there is a buy and hold? Because most of the time the risk is not in the business as much as it is in the valuations. So how do you think about risk of the first bucket? Let's focus on this part and let's close it first.
Sure, sure. So, in terms of the selection criteria, it's quite simple actually. Other than the usual, high ROE and all of that, I think the key criteria for me is, that the business should have survived and prospered in multiple cycles. So I don't want one cycle plays. So a lot of companies, right, are one cycle plays. So you have your, let's say an L&T, right? An L&T is called a blue chip, but L&T was a one cycle play. L&T did well only when the infrastructure boom was there, right?
Even
Whereas,
Avanti, I think you were invested into, which did well for one
yes,
cycle, I think. Yeah.
yes, I mean those are of course mid caps. Those I would put in bucket two.
Bucket two.
Those by
Okay. Sure.
definition are one cycle plays.
Sure.
So they are in fact a few. Depends on the company. Some of them, the 2-3 quarters turns out to be 6-7 quarters. 2-3 years and all of that. But amongst the larger names, right? So I want companies where the earnings have sort of grown across cycles. So that is the main condition. And only a few sectors really qualify that. And the two main sectors are financials in India and consumers, right? So even pharma has proven to be not so robust across cycles. There was, so when there was that tailwind of US generics, they did very well. But within the pharma space, I would say some of the MNC pharma names, qualify. And generally, if you look at the overall MNC basket, right, I think they will qualify as multi-sector plays across sectors. So if you look at the likes of an Abbott, or if you look at something like a Honeywell, or you look at something like a Timken, or some of these bearing companies which do not belong to the so-called sexy sectors, because the capital allocation has been good, the managements are prudent, they have proven that they can leapfrog across cycles and keep growing their earnings slowly and steadily. So that is how I would go about creating my universe of these so-called bucket one companies.
Is it fair to say that it's going to be a lot of quantitative stuff rather than too much qualitative judgment in this particular selection, what you just said?
No, the other way around rather, because
Okay.
the quantitative part is to the extent of like I said, you can just go on screener and find out a list of companies where the earnings have been growing across the last several years. Or if you are a technical person, then you want to see a monthly chart that is trending up from left to right, without with so these are stocks which are proven by the market, where the market believes in the management. And the qualitative stuff is more to do with the fact that they have not done any hanky panky over the last many years, right? Because the market very well, if you've done any corporate governance issues and all of that, the market punishes you, and that reflects in your overall return, and so on and so forth. So it's more to do with businesses which have good managements, no corporate governance issues. Now when you do a quantitative scan, you might come across some name which satisfies all the scans, but psychologically you will not be able to go and buy these businesses if you really don't know anything about it. If it is not a sector leader or number one or number two, although it qualifies all the scan, it will not come into your portfolio. Because and that's my sort of segue into your first question, at when do you buy these companies. And the best time to buy these companies is during a crisis, right? The best time, and not a company crisis, a market wide crisis. The best time to get into these companies is during a market wide crisis. And during a market wide crisis, no matter how many backtests we do, like I said, the quantitative screen will not suffice. You will need a qualitative element to be able to really buy things when they are falling, right? So typically, I keep a watch list of these, or a basket of these stocks, and some stocks keep entering and exiting this bucket, right? uh, so this watch list is a something which will be bought whenever there is a even a small market correction, or whenever there is a 10-15% correction in the market, because you cannot hope for that that 2008 or COVID fall, because then you will just be able to do it once or twice in a decade, right? So so it depends on the profile of the investors also. So we have several investors who are more comfortable with the first bucket, right? So the best time to buy into these is whenever there are 10-15% corrections, which are dime a dozen, right? Every 6 months you will get a 10% correction in the market, and that is the best time you can get into these stocks. And a portfolio of these stocks over a 3-4-5 year period generally will do fairly well. It will not do something phenomenal, but at the same time, these are the best stocks to participate in a bear market. Because in a bear market, you will not go and buy mid and small caps. Let's be, when you're putting in large money to work, right? The best way to get market exposure is to get into stocks where which will allow you to sleep at night. When something like COVID happened, right, where you don't know what's going to happen, but you still want market exposure, right? That is when you go to these kind of stocks, because that allow you to take that exposure when no other stocks will, when no other stocks will have the, ability to enter your portfolio.
Hi, friends. I hope you're enjoying this particular episode.
I just want to take a minute and thanks the sponsors for this episode. Stoic Talks was built on a premise of actionable insights and detailed questioning, and that usually requires the independence of doing that work. When you're looking for somebody to partner with, you are not only looking for somebody who will share your ethos, but also will promote this independence of asking fearless questions without any hesitations. So, when we were looking for someone like that, the obvious first choice for me was a DSP mutual fund. I have known their team, I have worked with them for a long period of time. They have this tagline called hashtag invest for good, which I really like because it really associates, which in my observation, I've seen them living this as the way of their life, and which is very visible. If you follow their work in public, they have done some excellent research efforts. They've come up with some amazing reports which everybody enjoys reading. For example, they have this report called Netra. Then there is the transcript, which talks about the con call transcripts. Then there is the annual report Nectar, the Navigator, and many such reports, which I enjoy reading and is enjoyed by many practitioners in the investment community. So we are extremely proud to be working with such a team. They completely agree with our vision for Stoic Talks, and I really want to thank them for supporting this particular episode. And if you aren't already, I would highly recommend you to follow them on Twitter. With their Twitter ID is @DSPMF. So thanks once again, and enjoy listening this show. Uh, okay, I understood, but I still need a bit more clarity in terms of implementation. So, on one part, we are saying that we should be looking at these stocks in the bear phases when there's an overall market correction, larger market correction, because obviously they provide stability to the portfolio. You have the market exposure, and you're pretty much certain that these are not the kind of stocks where you're going to have permanent loss of capital. So you're going to get your money back and probably quickly when the market revives, as and when it revives. Okay, so that part is clear. Uh, but then you also are mentioning about adding to these stocks with every 15% fall at a broader level in these stocks, which will be much more frequent than the broader market falls.
Yes.
So I'm still trying to get a clarity on how do you build this part of the portfolio. So just let's take an example. um, like COVID happened, everything fell, no question. I think at that point in time you will be buying a lot of these names. uh, at that point, is it fair to say that bucket one will be a majority of your portfolio? Is that how you see it, or you still have the elements of the other side of equation?
No, it's very unlikely to have the other side of the equation,
Okay,
especially during an event like COVID, because see, the other side of the equation depends on earnings, and
sure,
the
and the earnings
whole
are going
concept
to
of
take that.
earnings vanished, right?
Yeah.
So,
Okay, so that's fair. So 2000, COVID kind, it's very clear as to how your strategy is. Now let's go to the other, the more current situation where the quality names have taken a drawdown of somewhere around 25 to 30%, sometimes even 40, 45%. Uh, would you have been buying these stocks at the 15% drawdowns from the top? What was your approach in this market when we're talking about, let's say, 21, October 21 onwards, when the market started to fall and all these names started to correct? How did you approach your, this bucket building, if I can say that, during that time, with some examples that would be helpful?
yeah, I think, so exactly. So let's be clear that I'm not talking about a 15% fall in these stocks. I'm talking about a 15% correction in the markets, because,
Okay,
so whenever there's a 15% correction in the market, typically, this basket also will fall, 15% or more,
sure.
right? Now, at that point in time, so you would already be owning, some of these stocks, right? So by definition, these are stocks that you do not sell. These are stocks where you're sitting to compound your money. So now the question comes, of buying comes for incremental money. So, so if the incremental money is made available, then that money can much more easily go into these names. Whenever these, let's say when the index went, when Nifty went from 18 to, I don't know if it went to 15.5 or so, right? Uh, so whenever, it's in that panic phase, the Russia Ukraine war and all of that, and you get incremental money to deploy. So that is when, you look at your universe, and and then you go out and deploy wherever you feel there are opportunities. Well, let's say I think Asian Paints, right? Asian Paints had corrected quite a bit,
Mm-hmm.
right?
Mm-hmm.
In this recent fall, right? So you sort of go out and you already have Asian Paints, right? So let's be clear that in this portfolio we are passive. We are betting on the earnings of Asian Paints, and the market cap of Asian Paints becoming much higher 5 years down the line,
Sure.
right? And I need a way to sort of deploy my money.
Okay.
So a lot of these stocks, which had corrected, you could have gone out and confidently deployed money in this basket.
Okay. So, okay, fair point. So let's say you are deploying money, incremental capital, whenever, as and when it's coming to you into these stocks at the time of crisis. Uh, First, is it fair to say valuation is not a key parameter? Is that a fair assumption, or is valuation a selective criteria in these list of stocks? Then I will follow up with the next question based on your answer.
See, as long as the earnings are growing at a fair pace, there is no negative surprise on the earnings, then the valuations are, I would not say it's not a criteria, but see, trying to buy these companies at 15, 20 p is not going to happen, right? So I would not say that valuation is not a criteria, but as long as there are no significant negative earning surprises, let's just take an example of Divi's, right? So Divi's is something which qualifies into a multi-cycle kind of a play. It has compounded its money over multiple cycles, but right now Divi is in a corrective phase, but the earnings have just tanked, right? Which was apparent not only in this quarter but the previous quarter itself when they gave that guidance, right? So I probably wouldn't go out and buy Divi's, right? Even though it has corrected, and even though the market has corrected. Now, but if your earnings are status quo and the market has fallen, then I see that, and whenever the market falls, the P would have compressed a bit from normal. It would not, obviously, from the 60 would have become 55 or 50, and when the market bounces back, that 50 will again go to 60. That is the game there, right? So as long as there are no negative surprises, you are delivering on your earnings, you are growing at 15%, 20%, whatever you usually do, I will make a list of those stocks and pick out and go and deploy.
Okay. And when you are largely in these names, let's say a COVID kind of situation, obviously you will be shifting much before the actual bottom will form, because that's
Yes,
the nature of your
yes,
buying. Uh,
yes.
and they will revert much faster because they're quality names. When they do revert, what's your methodology around moving away from these stocks and then building your basket too? When do you decide to do that? Is it based on availability of stocks in basket too, or is it also that, okay, now these stocks are again back to their peak valuations or something like that, and I want to go out and start actively looking? How do you make that shift bit from basket one to basket two?
No, actually, the way we have structured it in the PMS is that these are two different portfolios. These are two different schemes, right? Because so by definition, there is no concept of shifting out from basket one to basket two. Because if you do that, then uh, like I said, the whole idea of basket one is that you are compounding your money. You are not losing a lot, and across cycles your money is compounding. There is no point in switching out from basket one and getting into, see, the whole, so that is what, so one has to be very clear, and that is what we will tell our clients also, that what is it that you want. See, you cannot get the best of both worlds. You cannot say at the right time I'll come into basket one, and then when the market that is all theoretical, right? I'll go into basket two. So 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 when an investor comes to me, we allow them to do the split between a core portfolio and, let's say, an aggressive portfolio, right? So if your core portfolio is supposed to give you a nifty plus some percentage return, that too will not happen every year, but it is going to give you a fair rate of compounding. So there is no question of really selling something. Sometimes when things go really euphoric, right? There was a phase when DMart went really euphoric. That is when you decide to take some money off the table. That is when you sort of do trading within your positions, with the intention of buying it back lower, right? Many of times it works, many of times it doesn't work, But when things really go crazy, that is when you can look at taking some money off the table, sitting in cash, and either deploying it elsewhere in the core portfolio itself, or buying back the same stock, once it corrects.
Okay, my bad. So actually, I was thinking that you're talking about two buckets within an individual portfolio, and that is why I was wondering about different allocations. But okay, so now this is more clear. You have two different offerings. You're managing both of them separately. In one case, you are more buy and hold, high quality names. Let's not use buy and hold because there is no such thing as buy and hold. You're still selling
Yes.
something.
Yes.
High quality. The focus is more on reasonable compounding rather than over and over extra returns. Whereas as part of second part of the portfolio is more active, more alpha focused, and there and you're asking your clients to decide a proportion based on
Yes.
based on their risk
They're
profile, how
That is
much
correct.
they want to take. Do
Yes.
you, by the way, also shift for a particular client between these two portfolios as a suggestion that okay, now probably you imagine that okay, this quality bucket might underperform for a long period of time, so it might be a good time to go out, something like that? Do you do those kind of calls for your clients?
No, no, I think rarely, because like I said, that will be against the
Yeah, that will
philosophy.
defeat the
So
purpose. It's the same thing all over
ye-
again. Okay,
yes,
fair point.
yes,
Fair
yes.
point. Okay, so okay, then I'll have to change my questions based on this new understanding. Okay, so this is now a separate portfolio, which is a buy and hold quality portfolio. Um, by the very nature, as you said, valuations then, since the universe in itself of great quality names is not very high. I mean,
Yes.
you can count on your fingers, 20, 25 stocks, which will probably be in this list. And I'm guessing you must be having what 20 odd stocks in your portfolio generally in this
Uh,
portfolio.
yeah, that is correct. 15 to 20 stocks.
15 to 20 stocks. So you have to play in that one universe. You can't go too much value centric, otherwise you'll not be able to buy.
Yeah, I think I have about a list of 70 odd names, 50 to 70 names.
Okay. Okay.
Like I said, it includes these MNCs and all of these.
Okay.
There are some mid-cap companies also, which so by definition, core doesn't mean large caps. It
Okay.
can be, good mid-cap companies which have good management, which have scaled up, which have, thrived. So it's a list of about 50 or 70, and depending upon the opportunities, I try to pick 15, 20 out of them,
Sure,
to build
sure.
this portfolio.
And is there a way you decide allocation in this fund? Because this bucket is not very difficult to understand. So we'll close this very quickly. Is there a
Yes.
way you divide between your allocations? Let's say higher allocation to some stock, lower allocation to some stock. Is there a way you go about it?
I used to do that, but then I realized it's counterproductive. Like I said, that conviction thing comes again. Higher conviction, higher allocation, and if the allocation becomes a bit too high, then you're prone to making mistakes. So I generally start off equal weight, and then let the market do its thing. And unless and once the stock starts doing well, unless there is a huge, and these companies will not become 4 or 5x, right? In the sense that in 6 months, they will 1 year, they'll not become 4 5x, right? So these are well-known companies, so the allocations don't go haywire so much. So you start with a 5 6% allocation, and I think you are sort of good there.
And besides business being challenged in some way or earnings collapsing like in DVs, would you get out of these stocks for any other reason? You have already mentioned valuation, but in extremely extreme cases like DMart euphoria, is there any other reason why would you exit these stocks, or there is no other reason you will exit these?
No, rarely.
Okay, fair point. So now let's actually, so this part of the portfolio, and I'm guessing you're looking for what, 15-20% compounding. Any other, do you have a benchmark return in terms of in your mind for these kind of stocks for this portfolio?
No, I think as public money managers, the endeavor is always to beat the Nifty in case of this portfolio,
Sure.
and in case of bucket two, you try to beat the Nifty 500.
But what will make you happy for this portfolio?
No, this portfolio, like I said, the alpha in this portfolio comes during bear markets. The alpha, in this portfolio comes during bear markets because, like I said, when the markets have fallen, you can have the confidence of putting money to work, right? Which is, not the case with a typical portfolio or the bucket two portfolio. So, and these typically, these portfolios will fall less during a bear market. So these portfolios, really give you that psychological hedge. I call it a psychological hedge. When your other portfolio, bucket two, is falling apart, this
Mhm.
gives you a psychological hedge to sit on your exposure, even in the depths of pessimism, right? Because you have
Maybe even
seen it
add more.
maybe even add more, and that really gives you a big fillip. It's kind of unfathomable how much alpha is there in just deploying incremental money during corrections.
Sure.
That itself is a big edge which a lot of people don't exploit. you know and the best way to exploit that edge is either you go out and in every big correction, when things are going crazy, just either go and put your money in some index fund, or just go and put your money in in a selection of these companies. So I think what makes me happy is that it allows me to sit through bear markets and really outperform in that phase.
Okay. So fair point. Now let's move to the bucket two wala portfolio. Obviously, much more exciting things to discuss there, right? Like a lot of what you have mentioned on your Twitter threads and your blogs about the themes, the way you pick stocks, and there are multiple ways you have tried to approach this, right? So let's now go down to some of the way you select your stocks for the bucket two, earning being one trigger. You have mentioned that, but you mentioned 4 or 5 ways in which you go about the core principles like momentum, mean reversion, and what surprise events. And I was listening to one of your I was actually going to a Twitter thread where you mentioned few more things like 52-week high, all week high, or all time highs, and some other patterns like this. So let's go into that bucket. And how do you go about screening the stocks for those buckets? Maybe a bit more detail, and then more at a doable level. How do you go about it? What kind of screens you have? Do you have quantitative way of doing things, qualitative way, and so on and so forth?
Yeah. So what I have observed, over several quarters of watching earnings is that if I do this study, every quarter or every 6 months, right? Anybody can go and do it. Just go out and find out the list of best performers for the last 6 months, right? And you will see that 50 to 60% of them will be earnings driven, and the remaining 20-30% of them will be news driven. All basically will belong to some theme. As a sector, the stocks will be moving up in the absence of earnings because the market is anticipating something. And 10-20% of them will be these low float, small caps, and all of that, which just move because of some operating activity or whatever you call it. Right. So I realized that there is a massive edge, and time and again, every quarter this happens, that companies which come out with blockbuster earnings, you know, uh, end up giving you, it's like free money on the table. It's like there is money on the table, but you should know when to get in and what to look for and when to get out. So you have to be very clear that these are not buy and hold. You are not going to get carried away by the fact that this company will become the next HDFC Bank or the next Infosys. So it's at best a 2, 3, 4 quarter play, right? In some cases, it's just a 1 quarter play. In the next quarter, the company disappoints again. You have to get out, sometimes at a loss, right? But this tendency, anybody can sort of go out and verify this. So my first screen is, so I'm very religious about checking the financial results. So every quarter, the beginning of the quarter, the first 45 days, I am extremely busy. Just I'll try to look at every number that has come. This is something I picked up from my partner. So we together we go through, I think, whether small cap, micro cap, nano cap. We'll try to go through every company, because a lot of times these smaller companies, right, give you because the results come early, they give you early trends, of what is likely happening in that sector, because the smaller companies are very sensitive to changes in the underlying economic activity, right? The larger companies do a lot of playing around with inventory and this and that. They will book something this quarter, next quarter. The smaller companies are much more sensitive. So so going through all of these results and keeping your eyes, ears open, gives you a very good insight into what's going to work in this quarter, right? What are the sectors that are likely to work in this quarter, right? And that is how we kind of picked up these small banks and
Any
PSU
of the
banks.
older examples, if you could give, say, something just popped out of nowhere, a company you were never tracking, but it came on your screener and then ended up becoming a good part of your portfolio, maybe a few years back, not a current position.
Sure, no, I'll tell you. So, like Globus Spirits was one, right? I didn't know anything about the company, right? And this is more of a quantitative exercise. I will say that this bucket is very quantitative. There are times when you might not study the company very deeply, right? And that is why this portfolio is much more diversified. This portfolio is 25-30 stocks, because even if you go wrong, I know that the odds are in my favor, because my study tells me that if I pick 10 stocks, at least 5 or 6 of them will work, and the 5 or 6 of them will give me, if they give me an average return of 25% in a quarter, and the ones which have not worked give me a loss of, typically they'll give you a loss of 8 to 10%, right? And because the earnings are good, you generally see that the companies in the worst case may not go anywhere, but they will not fall down like a stone, because by definition you're picking companies where the earnings are quite good. So I'll give you a few examples, right? So let me give you a few examples from this quarter itself, right? So right? So I think Apar was one, a couple of quarters back. You could have seen Ujjivan last quarter was one of the big surprises. If I can share my screen, like Puneet said, will that work, Puneet?
Yeah, absolutely. Please.
Yeah. So this is Ujjivan, right? Just as an example, right? So look at the just eyeball the numbers, right? So look at all of these quarters, it was doing okay, and then it was in a big mess, right? And it was this huge losses, and March was an okay quarter. And then if you see here, right, look at this, this financing profit, look at this top line, right? It suddenly something changed here, right? Suddenly something changed here. Look at the the PBT, right? This is at the quarterly level. So it has done a PBT which is higher than the last several quarters, right? And this was June 2022, so the result would have come in July, August, right? And you look at the stock, it was not doing anything, so there was neglect there, and the results would have come somewhere around here, around 20-25 bucks. And look at the move that the stock has made, and this move is driven by results, nothing else, and you can there is a you can almost find a 1:1 correlation between a lot of stocks getting re-rated and them coming out with surprise results. So there are two factors that I look for, right? So one is neglect, prior neglect. The stock should not have gone anywhere, the numbers should be very messy, and then suddenly you get a blockbuster quarter, right? And look at the next quarter, this current quarter. So after, generally I have seen about 2-3 quarters, the pricing and mechanism of the market gets over. So if it again surprises in the December quarter, the market may not give you the kind of re-rating which it gave you in the first and the second quarter, because the market is smart, it would have already priced in that things have already changed. So you will get an incremental alpha, but not so much, right? So let's look at another name that I mentioned earlier, Globus, right? It's right. So a similar thing happened, in Globus, right? Look at this, look at this top line, and more than that, look at the margin. This was more of a margin expansion story, right? So if not here, just look at how the margins, sort of shot up. A company that was doing 30-35 crores of operating profit suddenly gives you a 60 crores of operating profit, right? And September, so October, November, the results would have come. This was 2020. So this was that re-rating phase, right? So somewhere here, the results would have come. So from 1,000 it went to 1,600. in a matter of a few months. So this is the delta that you are sort of trying to capture, right? Uh, look at Karnataka Bank. So Karnataka Bank has given a massive surprise this quarter, right? And even if you bought it on the day of the result, it was up. It opened up 10%. I still remember. It's up about 20-25% from there in a matter of a couple of months, right? You look at another bank that you picked up. Again, these are banks I would not have touched otherwise, right? Look at J&K Bank's numbers. Nothing, 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 and then you get a blockbuster number. So yeah, I mean, so I think these are some of the examples.
Okay,
So
let me
basically, yeah,
yeah. So let me just get a bit more in terms of operationally. From what you're telling me, I'm getting a sense that to play these kind of names, you don't have a lot of time to study the stocks. I mean, obviously, because there is a earning driven momentum, and as you have rightly shown, immediately there are increases in the prices and the volume comes up and so on and so forth. So if you need to act on these, you need to act much quicker than the usual way of buying company where you study, you're looking for is there a, as you said, are the number trustworthy, is there any kind of shenanigan happening, etc., etc. You don't have time for all that kind of stuff. uh, so you're acting much more quickly. So how are you filtering out of all the exceptions you are getting in the market in, let's say, a particular way? Because again, assuming running in a running portfolio, every now and then you don't have way too many positions open in your portfolio also, that you can churn out entire portfolios. You must be looking for 3 4 5 ideas, so and so forth. So how do you zero down to those 3 4, if at all there is a methodology behind that? And secondly, then what's your risk management? Because if earning growth is the entry point, then is earning degrowing or stopping or slowing growth is your risk management? Or you also have price based, कि अच्छा इतना गिर गया तो मैं बाहर हो जाता हूँ, price based kind of risk management also in this case, in these kind of stocks specifically?
yeah. So let me answer the last question first. So yeah, I mean, there is no, the price based thing will throw you out. The price based thing, because what happens is during a quarter, results have come, and in those 3 month period, if there is an external event and you have a price based stop loss, you will be thrown out of the stock. So as long as I am confident that the earnings are good, right, I will hold on to the stock and I will wait for the next earnings to happen. And typically what I have seen is inter-quarter, if there is a correction in the stock, before the next earnings release happens, the stocks rallies back. If the market is anticipating, which will happen in most of these stocks, it will rally back. So if you have a price based stop loss, if you say 50 EMA below, I'm out and all of that, it will not work here. Yeah, right? Because an external event doesn't care what the earnings was, especially in these mid and small cap stocks. External event will just they will be selling and these stocks will fall. So you have to stay put, you have to take that risk to make money. Now how do you manage the risk? So like I said, the risk man, and like I initially answered your first question, right? Your portfolio construct is an offshoot of your setup, right? So the portfolio construct here by definition is very diversified. Now in my definition of diversified is about 30 stocks, right? For some people it's much more, but I think that 30, 25, 30 stocks is a fair number, which gives you, that, the theoretical diversification. It gives you the optionality, and it also takes care of the risk management, because what is the risk here? Like you pointed out, because there is not much time to go very deep into these companies, the risk is that you get something wrong, which is why I generally so these 25, 30 stocks, the allocation is 2.5-3% per stock, right? So even if a stock goes against me, let's say it falls 50%, I am losing anywhere between 1 to 1.5% per stock, right? And typically I have seen, because there is a big earnings surprise, right? There's a difference between a big earnings surprise and a good earnings number. I'm not interested in the good earnings number. I want a blockbuster earnings. I am not interested in the good, because you will find hundreds of good, right? So typically I have seen that there is incremental buying. There is, even if there is a correction due to an external event, these stocks are the quickest to bounce back. Having said that, there will obviously be mistakes. There will obviously be stocks that will, not move up because you made some error of judgment. It was a commodity company. It had a 1 quarter of extremely high, earnings, right? So, but I think the winners, kind of take care of, a lot of these things which don't work out. And the third thing is that, my experience of the last 15, 20 years in the market, having, looked at all of these businesses, gives me that first level of due diligence. If a new guy is doing it, he will be in, much more difficult space. So I know what a Vakranji is, right? So if Vakranji gives me blockbusters number, I'm not going near it, right? So I know the difference between, a company which has gotten beaten down because of a bad cycle, and a company which is beaten down because, of some, shenanigans that, the management has done. And if you really study these numbers across quarters, you can even find patterns in how these managements work. You know how a lot of managements do a lot of inventory stuffing. Who do a lot of these gimmicks. How the other expenses shoot up, and a lot of these things happen. So I think that knowledge database which has built over the last 20 years gives me, that itself is a fair bit of risk management, which gives me a fair idea of what this company is all about. Because in the all of these years, I've seen most of these companies, at least, if not very deeply, but I have a sense of what they are, who the management is, and all of that. So I think all of these things put together, a fairly lower allocation, more diversified, having a base level understanding of the business and the company, right? And the fact that the earnings are a big surprise after a period of neglect, it takes care of a lot of risks, at the portfolio level.
Sure. And I I think I have the sense, but I'll still, for the benefit of the listeners, clarify this. When you are doing this kind of blockbuster result seeking, do you make some compromises on the more commonly followed, checks and balances, like capital structure might be a bit stretched. Let's say you're not comfortable with debt to equity of the company, or some other balance sheet, sanity checks which people do. Would you and when I say compromise, I'm taking into consideration the fact that blockbuster results is taking a very high priority in your decision making here. So is that a fair way to say that you will do some kind of compromises you're okay with, and also on the valuation front? So these two things, if you can comment on,
No,
will those
the
matter?
more dirty it is, the better. And when I say that,
What sense?
not from a corporate governance point of view, right? So that
Yeah,
is that is like the red line, right? So you don't get into, a PC Jewelers, or you don't get into a Vakaranji, or any of these kind of names where that, and there are some managements you're inherently uncomfortable with, because so the Birla Group companies or something like that, I will probably, avoid. These are like the blacklist. But otherwise, if the balance sheet is bad, all of that, I feel reflects in the neglect part. A lot of people ignore the neglect part and they focus only on the blockbuster earnings. So the fact that they are neglected, by definition, means that the valuations are not stretched. There is no froth in the stock, right? And that, when it combines with a surprise number, right, really. And there's one more additional layer of, check that I put, is whether it is happening only to this company, or is it happening across the sector. If it is happening across the sector, you can be much more sure. The reason why I could, bet on a J&K bank, which is one of the shadiest of the banks, right, uh, is because it was a sector. It was a entire credit cycle, and, end of the provisioning, beginning of the new cycle, whatever narrative you want to give to it, right? It was an entire sector getting re-rated. So in those cases, actually, like I said, the the worse they are, the better, which is counterintuitive.
Also, I'm getting the fact, I mean, considering the fact that your holding period is not going to be that long, balance sheet risk also is not going to come into play for a shorter time period. It's much more prevalent risk when you're looking for a very long term holding anyways.
Absolutely,
So okay.
absolutely, absolutely. And like I said, with this tailwind of a good result, right? Generally, the stocks don't fall like a stone. So, what is the worst that can happen is you can lose 10, 15, 20%. Unless some, like I said, a corporate governance issue comes as a surprise, which you anyway nobody can control. It can happen to any stock, right? If something like that happens, of course, and that is taken care of by the allocation. That is taken care of by that 2-3% allocation. Even if you lose, and you will, right? You will, nothing will work for all the stocks. So it's a mix of these things.
Yeah, so another example which you were talking about, that because you look at so many results, you tend to get an understanding of the sector and possibly an allied sector, right? Say, for example,
Yes,
this
yes,
company has done bad, implies the other company will do better, given that this is the raw
yes.
material producer and this is something who's a consumer.
True,
Maybe you could give an
true.
example because you discussed that as one part of your pattern, and then a blockbuster
Good.
running coming in the same thing. Any
No,
example you remember?
yeah. So no, like I spoke about the tires, right? So so you can expect, so all the rubber companies to, give, start getting the margins getting compressed. A lot of rubber companies would have seen their margins, a lot of chemical companies, right? Why just rubber? A lot of chemical companies, a lot of commodity chemical companies or commodity companies will see their margins being compressed from the next, for them from the next quarter itself, right? And and you can already see that a lot of companies which gave out blockbuster numbers, right, actually ended up falling because that is also key because you want a fresh blockbuster number. You don't want a blockbuster number which is 3 or 4 quarter old. So if a company, so a lot of these companies like Deepak Nitrite and all of that, we participated in them, when the going was good. But once you realize that one of the ways in which I exit the stock is also if I feel that the margins have peaked, that these are unreal margins. If you look at the history of the one company, right? The company that was doing 15-16% OPM is now doing 40% OPM. You know that it's not sustainable unless it has immense pricing power. So if you see a 40% OPM for 1 or 2 or 3 quarters, you know that this is it. Now this company is going to be stuck for a long time, just trying to outgrow the EPS, the record EPS that it earned, because even though the revenues will keep growing, because the margins will compress, the EPS will keep falling, and the stock will go nowhere. So, so especially the commodity companies, right? So when the commodity companies start coming out with bad numbers, you know that the tire stocks will likely see a margin expansion from the coming quarter.
Yeah, I mean, yeah. So what you're saying is actually more applicable only to those kind of names where historically the numbers are very reliable. Also, like it's a cycle, and you can see the historical cycles, and you can know that okay, this is probably the range in which
Yes,
the margin should peak. But something like a
yes.
Karnataka bank, you will not be able to do that kind of working, obviously. Um,
No, no, no.
okay,
You can't preempt. You can't preempt those.
just one question prompt to my head. It have nothing to do with your investing style per se, but how do you manage, or if you at all bother about, does it bother you that some bad quality names are going to make way into your portfolio and it's going to impact your, the image of the portfolio or image of you as a fund manager, or your clients might object, something like that? Is that ever been a thought behind? Or because I've known some people avoiding these kind of companies badly from a reputation point of view. So does that seem like a risk to you at all? Ever bothered you?
No, see, when you're managing public money, right, these things, I will not deny that these things are important. But the thing is, Puneet, if the returns are coming through, right, investors don't mind because money has no color, right? So investors really don't
You have
mind.
good investors.
Absolutely. No, and that's a fact.
Yeah.
That's a fact, and that is a fact by design, right? So we have no, like, we don't have a sales team. We have no sales approach. There is no. So we've not signed up with any distributor, although we had a lot of distributors come to us. We have not tied up with the any of these wealth management firms, right? So, and that is by design. We want to only deal with people who understand markets and who have been through cycles, right? And like I said, I have that psychological hedge, bucket one. Bucket one is what, is, where you have more than enough quality, to compensate for the lower quality stuff in bucket two, right? So every investor that we have typically will have a mix of both of these portfolios. So that's not really an issue, and I don't really bother with it, because I have told this to my investors, right? By design, I have said that I am going to chase earnings, and and it is going to be, the portfolio itself is called active alpha, right? The portfolio is called active alpha, so it's very clear that it is active in nature, and the mandate is to generate alpha. So we will go down the quality curve if we have to, if that means that is where the money is.
Stoic Talks has been partnered by DSP Mutual Fund, which was an obvious choice for us, having interacted with the DSP team earlier and recognizing how they are obsessed with helping investors take better decisions. Some examples of their motivation to help investors do better are visible in their research related work, which they make available for free, including Getting Smarter, Tathya, Report Card, their Invest for Good blog, among others, and many more reports. We thank Team DSP for supporting this episode of Stoic Talks and recommend that you follow them on Twitter. Their handle is @DSPMF.
Okay. Is this the portfolio where you also do the short part, because you have one long short?
No. That is the AIF. That is the AIF.
Which is where your quality bucket is. If that's, am I drawing the parallel correctly? No. So can you just explain that part? I mean, you have one AIF, one PMS. Where do you do quality? Where do you do long short? What exactly is the way you go about it?
No, the PMS has two schemes, right? So
Achha.
one is the quality, and one is this bucket two, right? The AIF is a separate vehicle. The AIF is a separate vehicle whereby, where elements of this quality and bucket two portfolios are there, but we also have other strategies there. Yeah. So AIF is a different vehicle. So AIF is a vehicle where, we do a lot of options, we do a lot of hedging, and we do a lot of index trading also. So that's a completely different vehicle. But within that, there are portions of both bucket one and bucket two, but it includes many other strategies.
Okay, understood. So yeah, so okay, this part is clear. Before I go to the short side, let's discuss few more triggers of picking. So one which you have discussed right now, which is the earnings driven, which you call PED category of stocks. You have discussed some more themes or some more triggers. One being price action driven, which is 52 weeks high and all time high once. Another one which which was interesting was the capital structure driven, which is debt reduction. Can you talk about debt reduction? How do you screen for the companies, and what exactly are you looking in those stocks?
Yeah, I mean, so what we figured is that debt reduction drives as much EPS growth as your regular organic growth driven by the top line, right? Because when you reduce the debt, a lot of that interest component which you are paying, that flows down to the bottom line. And and a lot of times this is neglected by the market. So debt reduction as a pattern, it takes a lot of time to play out. It's not as quick as these earnings kind of bets, right? So it is something where you know the company, you've been tracking the company for several quarters, and you see a trend of reduction in debt. So we did that with Radico Khaitan, right? So Radico is one of the companies which consistently has been reducing debt, and we have seen the stock getting re-rated over the last 2-3 years. But this is a much more rare and much more slow phenomenon. But it's something to keep an eye on, but it's not one of the primary patterns that we use.
So which one will be other primary patterns besides the PED which you have discussed?
So like I said, so it's always a combination of one or two. Like you said, 52-week high, all-time high. So we never just go out and blindly buy a 52-week high and all-time high.
Sure.
Right. So that we don't know. But if you have a mix of multiple patterns, right? So like I said, if you have a PED which is driven by a mean reversion in the like earnings have fallen a lot, and the earnings on the margins are now turning. The margins have fallen a lot, the margins are now turning, and you have a PED, and the stock is hitting a 52-week high, and it belongs to a group, which is as a group this phenomenon is happening. So when you put these three or four of catalysts together, that those are the kind of stocks which typically get an entry into the portfolio. So if a stock has a blockbuster earnings, but if the market is not reacting to it, then it's unlikely that I will get into it. So it's a mix of multiple of these patterns which when culminate together in one stock, that you increase your probability of turning that stock into a winner.
Okay, so let me then change the question. Let me ask you, how do you, what's your origination point? So since you must be, one is obviously you're reading the results, so is that the only origination point, and then rest are just acting as confirmations? For example, a 52-week high is a confirmation, or all-time high is a confirmation, or you have multiple entry screens, one being your result surprise, but other screens being 52-week high or all-time high. How do you start? What's your starting point, and then how do you converge?
Yeah, so you're right. So the starting point is not always earnings, because you can't really find everything organically, right, by going through the results. So if you find it, that is the best way. Otherwise, we screen for 52-week highs. We screen for all-time highs. We screen for relative strength, and then go back and check the earnings of those stocks. And we look for let's say the last the top 100 stocks for the last 1 month, 3 months, 6 months, these buckets, and then look at if there are any themes or any specific sectors which are visible there, and then go back and see if something interesting is happening on the earnings side. That's one way to look at it. You go from price to earnings. The first one is you go from earnings and then use price as a confirmation. The second is the other way around, and the third is sometimes things are narrative driven, right? So sometimes things are like what's happening with defense, right? Not much is on the paper right now, right? But there is some narrative, there is some policy talk going on, and you can see that there is a re-rating happening across the board, right? So you go out and you can buy whatever looks interesting there. Some of them have posted even good numbers. So I think the ones which have actually done well, like Mazagaon and all, they've actually put out good numbers also, so they would qualify your earnings criteria also. But it's basically either price action or news, or the organically the earnings itself. So one of these three places.
But tell me one thing. In this case, then your risk management for all these three different type of approaches has to be very different, right? If let's say you are going for a narrative driven stock selection where the numbers are not really showing up a lot, you can't go into the stock hoping for the numbers. Of course, if they come, great. If they're not, but then since you are not entering on the basis of some strong fundamentals existing in the market, you can't exit on the basis of fundamentals not being performing. Your risk management or your exit, let's not call it risk management because that is allocation, but your exit criteria then have to be very different for all these three. So would you care to comment on the exit strategies for these stocks?
No, generally, I would say 90 to 95% of them are earnings backed. So one of the triggers has to be earnings. So that's why I use the example of Mazgaon dog, because I picked Mazgaon because there were earnings to back it. So otherwise, if you're just playing on the news, then you're playing blind. Then you don't know. Like you correctly said, when to exit. So there has to be an element of earnings, because especially when you're managing public money, right? You cannot buy something based on any of your own whims and fancies, right? So earnings is something, or at least an anticipation of earnings. So even if the earnings are not there right now, like you said, there has to be some. The markets always go up in anticipation. The markets are all about the future. The markets are all about trying to predict what will happen in the future. So there's always an anticipation of the good earnings coming through, right? So then you have to track that anticipation. Now, as long as that anticipation is there and that translates into numbers within a reasonable period of time, you're there. And if some event happens, let's for example say that the general elections, right? The current government does not come back to power, right? Then your whole thesis of defense is gone, right? Because you don't know what the new government will do. So the whole perception of the future earnings will change. So if any such event happens, or then you can take a course correction.
Okay. Okay. So, okay. Then I still, need some things to bind these together. You are okay. First of all, earnings being there to support your thesis comes out as a very prominent idea in all of your cases, right? So this is
Yes.
not a portfolio where you are betting on the reverse side of things, where you know things are out of favor, earnings are not coming, and you're betting on the reversal of earnings because the price action also have not come. So this is not where you're doing bottom fishing in any way whatsoever. um,
No.
uh, in this scenario, when you're doing earning based thing, what are your checks for the other side of things, like balance sheets, quality of earnings? Do you have any such checks for these companies? Most of the value investors talks about management quality being there and capital allocation history, etc., etc. uh, what How much of evaluation of stocks from those vantage points come into your evaluation when you're focusing on earnings primarily?
No, see, all those things become important when you are trying to anticipate or guess, do a guesswork as to what the earnings are going to be, right? That is when the management quality, quality of the balance sheet. So why is the quality of the balance sheet important? Let's understand that, right? So quality of the balance sheet is important because for a value investor, he doesn't know whether the earnings will come after 3 years or 3 months, or 6 months, or when. So quality of the balance sheet is important because the company should be able to survive the demand destruction phase that it's going through, right? So typically value companies, right, what happens to them is there is a demand destruction, there is a demand destruction, and or they're going through a cyclical low, right? And you don't know when the demand will come back, and that is typically when value investors will buy them, in the hope that the demand comes back. So you need a strong balance sheet to weather any storms that happen in the interim, right? So here what I am betting on is something which is happening in the here and now. The earnings have already come through. The first quarter of good earnings have already come through, right? I'll give you an example. I don't want to name any fund managers or anything like that, but there were some fund managers who very nicely picked a lot of these capital good stocks in the last cycle. Some of them include names like the LG equipment, Power Mac, some even some alcohol companies and all of that, right? The stocks did nothing for 2 3 years because they were trying to preempt the earnings, right? And unfortunately, COVID happened, and uh, again there was a delay of 1 or 2 years. So there is a so I feel that there is a limited edge, unless you are really an expert and you really know the industry in and out, and you have some knowledge to be there at the right place at the right time. There is very little edge in analyzing, especially for these companies. So here I don't want to play the bottom fishing game. I want to play the bottom fishing game in the bucket one, because in bucket one I have the clarity of thought that these companies will bounce back. So everything that you spoke of, right, the qualitative parameters are taken care of there. So I know that if I buy them on a correction, I, as a portfolio, one or two stocks may still not do well there, but as a portfolio, I know that these have all the ingredients to give me a fair rate of return. But here, these other mid and small cap companies, I don't want to give them that benefit of doubt. I don't want to say ki aega, earnings aega. I hope it comes. Valuations are low. So I want to, I don't want to give them, any leeway. You show me the numbers and I'll allocate. So, so when you're, so when you're doing that, the other things, when the good numbers have come through, the other things become a lot less, material.
So, do you take a cash call in this portfolio as such, or it is always a replace and refill?
There are cash calls, like I said, during uh, when the market, see, one of the key things for all these setups is the market and understanding the market environment. So in a bear market, nothing will work. In a bear market, even if you have great earnings, the prices will not go up, right? So typically, if I get a sense that the market is the market as a whole is turning around, then I will take some cash calls, and I will sort of do some risk management by cutting positions across the board. Even there, I don't try to pick and choose, right? So the pick and choose I will do to the extent of if some stock has given me phenomenal returns, right? It's up 70, 80, 100%. I will trim that. you know uh, Otherwise, I will do an across the board trimming to raise 15, 20, 25% cash, but generally don't go beyond 30% cash.
And any examples where, say, it just totally flopped out for learning purposes, say maybe a couple of stocks or sectors which actually flopped out for you? There was no follow up in the numbers in the next 2 quarters.
Yeah, I think one of the examples I give is, it's now come back into my portfolio, but in the earlier avatar, I think Ujjivan was that example, right? So Ujjivan was, doing really well post the IPO, and it was posting very good numbers, and then demonetization happened, and everything for microfinance went completely for a toss. And at that point in time, I had this idea of conviction with me, and I held on to some of those names, and I had to book losses and get out. Typically, what I've seen is financials, right, as a category are a very dangerous category to be in, because any negative surprises there are amplified, because of the inherent leverage, right? Any negative surprises that are amplified, so I try to limit the amount of financials that I have in my portfolio, as a percentage of the overall basket.
Okay, so all right, so got a good understanding about how you're approaching the market, and fair points towards the importance of other primary things which people are seeking. You're not really seeking those comforts because your holding period is not like a traditional value investor who is adding at the bottom and waiting for things to turn. You are betting only when things are turning themselves, and this is a common theme across all the pattern which you have discussed, because all the things which you have mentioned there, let's say a 52-week high, if the price, you said price not moving, you're going to be very wary because earnings are coming, price is not moving, it's a red sign for you, red flag for you. So 52-week high, all time highs, speed, etc., all these things are adding up to your the philosophy which I'm able to guess. Just a few more questions. Risk management, as you said, it's being taken care at the allocation level, um, but also a majority of the earning surprises can also happen at a sectoral level. So do you have a limit at the sector level that, okay, let's say metal companies are coming, I'm not going to go beyond, let's say, 15%, 20%, something like that?
Yes, yes. So, like I was answering Noresh's question, so generally I will try to avoid, one sector being more than, let's say, around 15 odd percent. Because what happens is, like I said, the sectoral correlation, is very high. So if something goes wrong with one company, it typically impacts, all of them together. So to answer Noresh's, earlier question, see, most of the times, this, I call it earnings momentum, because, by definition, momentum typically lasts for at least a couple of quarters. So the cases where, this really fails, is mostly when some event happens. Like I gave you the example of Ujjivan and demonetization, or, the Muthoot Cap was one of the companies, the Kerala floods happen. So if some event happens is when, typically this, fails. Or there are some companies which will, give you a blockbuster number, and then completely, disappoint. I think recently that happened with this company called as Orient Bell, right? It came out with very good numbers, and then the next couple of quarters it didn't follow through, right? So in some, but you still end up, not losing a lot, because that tailwind of the good earnings, the first quarter gives you some cushion because the price moves up, and when the next quarter it disappoints, you are still able to exit, around your entry levels.
Okay. And so this is at the cost level. It might be a possibility that there is a blockbuster cycle taking up all the stocks pretty high, and your one sector allocation is actually going beyond a particular number. Do you start to trim your positions? You completely move out of those kind of stocks. Let's say you have given examples of metals in past in your portfolios. So if you go into a metal or a tire kind of sector, 15% at cost, uh, let's say it becomes 20-25% of your portfolio. How do you manage that part? Do you trim
No,
your
yeah,
positions? Do you get out of those positions because the profits have been there? How do you go about it?
no, I do trim my positions, because by definition we are not holding these for very long periods. Right? It's just a 2 or 3 quarter play. So I cannot possibly play for those multi-bagger 4x 5x kind of returns. So
Sure.
whenever I see a big number, 80%, 100%, the stock has gone up, I do not sell the stock completely, because my selling only happens when I feel that the earnings have peaked out, or if the earnings are not following through. But I will most definitely do a trimming whenever things go haywire on the positive side.
But is it contingent on you getting other ideas also, or you will go in cash if no other ideas are there?
No, generally I try to play it quarter to quarter, right? So what I do is, by the end of one quarter, I would have had my portfolio positioned to play the next 3 months, right? So
Wow.
at the end of the 3 months, as the results start coming in, I will, by evolution, have some candidates which will be wanting to go out, and give way for the, because some of these stocks would be second or third or fourth quarter, so those which have aged more will kind of go out, because the juice is sort of out of them, and the new ones will sort of make place for them.
Hmm. Hmm. What will be your churn in this kind of portfolio? Obviously, it is much higher, but generally, what's an idea about that?
I would say out of the 25 odd stocks, I would say about 30-35% is what I would put it to.
Wow.
Uh,
Okay.
in any given quarter, I would probably replace 5 to 6 stocks.
Okay. One part. So you mentioned 4 or 5 things when we were talking about the structures of these kind of companies. Momentum being one, mean reversion being another, surprise event, small cap, and small float. And you also mentioned exhaustion as another theme. Now, when you're looking at exhaustion, how are you how are you assessing that? How are you judging that? Is it price action, or are you also evaluating, let's say, holding percentages of some key holders, and how are they responding to the whole thing? How are you going about this whole process of exhaustion?
Yeah, it is one is definitely price action, so you can kind of see it on the chart, right? Uh, Second is more to do with sentiment. Second is more to do with Twitter, CNBC. So I think that plays a big role. What is the crowd talking about? What is the like I said, the moment, like I said, I gave you the example of tech, right? So there was so much euphoria last year, right? So you knew that it cannot sustain, right? So it's actually more qualitative, I would say. You can definitely, so when I spoke of exhaustion as a structural tendency, I was coming more from an ability to build a setup around it. So you can build short setups around exhaustion. You can build long setups around selling exhaustion, right? So these are shorter term plays for those who trade, right? And also, one of the biggest timing indicators that is used by a lot of professional traders is the market breadth. right? So when the market breadth, gets exhausted, which means that when you get, so let's say there are different indicators which people follow, but let's say number of stocks below 50-day moving average, right? When that number goes to single digit, you know that a market turn is coming. When the number of stocks, and I think Nuresh is probably an expert in this, but the breadth indicator, whereby, so that is an exhaustion setup. That is an exhaustion because there is exhaustion by the sellers. Everybody has sold, and now the number of stocks which are, you will see this in every downturn on the chart. You go back and check the breadth, it will typically be in single digits. And doesn't mean that you will pick the bottom, but you'll be very, very close to the bottom. When the breadth goes down to 5%, 4%, 3%, 8%, you know that a lot of selling is done and there is a swing move that is going to come. That may not be the ultimate low, but so you can build trading setups around exhaustion. So that is with the trading thing in mind. The other thing is more qualitative. The other thing is more observation and watching. Like I said, I gave you the example of PSU banks. There it was completely neglected, completely under-owned. I gave you the example of tech. Look at cryptos, right? Cryptos is is a buyer exhaustion. At some point, it was a buyer exhaustion. So those can be used for more of macro calls and such narratives. Uh, so you can look at it two ways. You can build trading strategy around exhaustion, or you can look at it in a very macro way. To sort of build any thesis around how the market will perform.
So for long positions, I'm then guessing exhaustion is more like a confirmatory. It's not a necessary condition. It's more like a confirmatory thing that okay, if it is there, it's even better, rather than being a selection criteria. Is that fair point to say?
No, exhaustion. For long position, exhaustion comes when there is extreme selling that is happening on one side.
Sure.
There is an extreme selling that is happening because of some event, and you can only use it as a like I said, you can use it as a market timing indicator. For an individual stock, it may
For
not
individual
work so
stocks.
well.
Okay.
It may not work so well, but when you look at it as a breadth indicator, you will see that when there is exhaustion across the board, most of the stocks have fallen. And there is hardly any stocks which are up above the 50 EMA or something like that. Then you know that a market turn is coming.
So, in say in parameters, say maybe the way I look at it, 40% of the stocks are down 40%. That tells you the breadth has been worst. So that has been a criteria where it has been in 2008, 2013, 2020. So breadth
Yes,
criteria could be the moving average or the absolute price fall. But
yes,
I think,
yes,
and we
absolutely.
saw this happen in 2020. It was very close to 2008. The breadth was almost similar to 2008. And the worst part was there was
No,
no bull market before it.
yes. It's a brilliant timing indicator. It's a brilliant timing indicator, and if you study the, a lot of professional investors, especially abroad, and this is, I think they have something called as, I think, T2108 or something they call it. It's an indicator in most of these US systems, which is a breadth indicator, which tells you, when can you play for that swing up move, after a correction.
Naresh, we need a session from you on breath indicators.
I keep
Right?
writing about breadth. So I have an article written on 23rd
I
March
yeah.
2020, but nobody was interested in
Yeah, so
reading
now
it
what we
back in
need
then.
to do is we need to take all your articles on breath indicators and do a podcast with you specifically on this.
Great.
Acha, so, Prabhakar, just let's close this discussion by discussing one side of equation which we have not touched at all, which is the short part of your portfolio. They say shorting is a completely different ball game compared to a long side of equation, because long side may uh, there is some sanity that you can expect at the bottoms to come. It's much easier to see that okay, things might turn from here. The insanity on the when you're trying to short is much difficult to put your finger to. So first, how have been your experience on shorting? uh, have you been successfully deploying this, or is it a learning phase you're going through? What exactly is your learning curve there? And some nuggets for us, if you can, what have you learned in the shorting side of the equation?
No, I would say, in one word, if you can avoid it, avoid it. You know. So I'll tell you why. So we've done a lot of work around this. Now, shorting, right? So it is not the opposite of going long. A lot of people think that if you just use the opposite of the long strategy, you can use it on the short side. Now, number one, you cannot do, you can rarely do long-term shorting. A long-term shorting is possible only in the fraud candidates. Once you realize that something is a fraud, you can short it and you can keep rolling over your positions, and that is one. Second is, in India we do not have a very active SLBM market. So there are only few set of stocks which you can short, and most of them being large caps, you get only a few opportunities like a Yes Bank or India Bulls or Reliance Capital, which comes once in a few years. So you cannot really create a setup out of that because they are too rare, right? So long term shorting doesn't work. I feel that shorting works over a very short time frame. So if you want to play shorting, it has to be played in bursts of maybe 3 to 5 days, nothing beyond that, because by definition, there is a tendency of mean reversion that comes into play there. Because most of the players in the market, whether it's institutions or retail, most of them are natural buyers, right? So whenever a stock falls, there is natural buying that comes in from the institutions. Now I'm talking only about, because we don't have SLBM here, we're only left with the FNO stocks to short, right? And within the FNO stocks, as soon as like I said, unless there is a corporate governance led event, if you are shorting in a regular market, you have to be very quick to book your profits. You cannot allow the shorts to linger, right? Like in longs, they say, let your winners run, right? In shorting, in my experience, that is not true. You cannot let your winners in shorting run. You have to book your profits, because the short coverings that come are crazy. And if you are leveraged and all of that, it can completely wipe you. And it has happened with many players, right? So stock shorting is something which can be only done as a short-term trading activity. Now it comes to hedging, right? It comes to hedging. A lot of institutions, what they do, including us, or rather what we used to do, now we have stopped it, is to use Nifty as a hedge against your stock portfolio, right? And people who have been through 2018 to 2020 will tell you that was the most stupidest thing one could have done, because only the Nifty went up. The stocks just did not go up, right? So you lost on both the legs. So right, so if you're using Nifty as a hedge, or a bank, bank Nifty you can still use against bank, but Nifty as a hedge, because of this index fund phenomena or whatever you call it, there are natural buyers in Nifty, right? So you cannot use Nifty as a short. If you use Nifty as a short hedge against your long portfolio of stocks, I think you'll be taken to the cleaners, right? So then what is left is, you have a long stock underlying, and you can hedge it using the call and put options, right? Even there the story is crazy in India, because there is no volume. You go to stock options, right? Any decent sized institution can hardly do any hedging, right? So the bid and ask only, you will be losing money, right? So all in all, shorting is not worth the, I would rather you stay in cash. I would rather you come into cash, rather than try to play on both the sides. Other thing with shorting is a psychological one, right? So if you have an ability to short, your mindset becomes pessimistic, right? You start thinking that I want the market to go down. I want the market to go down, and you get into that sort of a negative mindset. And what then happens is, you are not primed to play the recovery, right? So if you get into that shorting mindset, then as the market is falling, you'll keep getting happier and happier, and your positions will be zero at the market bottom. And when the market turns, you will miss the entire recovery, and you'll also lose money on your shorts. So net net, it's an exercise which can be only done as a very short term hedging or very short term trading strategy.
Okay, but then tell me one thing. In this particular case, since you mentioned exhaustion as one of your way to study the market breadth, and specifically when it is exhaustion happening at the buyers getting exhausted in the market overall, uh, uh, do you try to then do hedging? At a market, you said Nifty को नहीं use करना है, but do you then use Nifty for your hedging of the portfolio at certain points in time when you think that okay, the exhaustion is there, or you're saying all of those also do not have enough predictability or enough certainty in terms of action?
Yeah, no, the thing about exhaustion is that it works on the seller exhaustion, right? Like I said, on the bottoms it works, breadth works very well, but the breadth doesn't work as well on the long side. Right? On the long side, just because 98% of the stocks are above the 10 EMA or 50 EMA or whatever, doesn't mean that the market will fall. The market can remain in an overbought situation for a much longer time. So, so this whole exhaustion thing works more when you're trying to go long during a market correction, rather than using it as a a thing to go short because of buyer exhaustion, right? And buyer exhaustion typically happens in India in the thing you see you get an opportunity to play buyer exhaustion when things go parabolic, and things do not go parabolic so much in the FNO stocks. Things go parabolic in small cap stocks, and you can't short them, right? If you short them, then you can get into uh, all kinds of delivery troubles and all of that. So our market in that sense is very unique. So you can't play the short game in our market. It's very difficult to, unless you're doing it for a very short term. Intraday or 1 or 2 days. Anything beyond that, you are setting yourselves up for failure.
So your long short is basically long only. It's very little short
No,
in
no,
your.
we do hedging, but it's all very shorter term in nature. We do
Understood.
not have any. When people sometimes call long and short, they will be something like, I'm long private banks, I'm short PSU banks. So we don't do that business,
Okay.
because we've seen multiple times. When that recapitalization news came, I think a couple of years back, PSU banks just went crazy, and such portfolios were taken to the cleaners who
Yeah.
were short the PSU banks. So what we do is, on our underlying position, we do hedging
Covered calls and
with
all.
the covered calls, or we buy puts, and
Hmm.
we are quick to try to take profits. But even then, I would say, net, it's more of a psychological thing.
Hmm.
So you do not expect to make a lot of money out of going short or hedging.
Perfect. Perfect. Great. Yeah. So again, the questions will keep on coming, but I think we have to bring a pause somewhere. Brilliant session, Prabhakar. Lot to learn. I will take a lot of, I have already taken a lot of notes. I will probably put a lot of this into practice and see, maybe share with you the outcomes which I find.
Sure,
It
sure.
was an amazing. I'm sure the listeners are going to learn a lot, and a new learning from me in terms of uh, my understanding about your working, because when you said the bucket 2 explanation, I would have never fathomed you to be on that side that much.
Yeah, no, I don't talk much about bucket two, because bucket two is very nuanced. Because you can't talk about it in public, and people, you can also, if you don't know what you're doing, and if you, like I said, if you misunderstand, that these are shorter term plays, and you try to, hold on to your losing positions, or you get into the hope mindset. So it is not suitable for somebody who has not worked on this bucket two business for at least several quarters. So it takes a few quarters to get the hang of it. It's not rocket science, but you will have to understand the nuances. Something on a public platform,
Yeah.
people take it verbatim, right? So
Yeah.
And it
No,
needs a
so
detailed
I mean, we
discussion,
have
and that's
covered a
why we
lot
had
of.
a detailed discussion, so it helps.
Yeah, so what these nuances generally do is that it gives an idea to a person that whether this is for me or not, because at
yes,
the broad level everybody thinks that okay, this works, but also to people who are willing to put in the effort to learn the nuances, this also gives a
yes,
confirmation that practically money can be managed, and you have been doing it for
yes,
some time now successfully with decent returns with strategies like this. Otherwise most of this is usually talk. People talk about trading, value based trading or fundamental trading, etc., but nobody has a real record to show that okay, there is a significant money can be managed. It's not small capital. I think you're managing upward of 500 crores across both your schemes, right? Maybe more than that. I'm not sure about the numbers.
that is correct. Yes,
Yeah.
that is
So
correct.
if you're doing that, it's obvious that given all the normal discussions around liquidity, and you have been managing all that within this strategy. So to a more venturing learner, this also gives a ray of hope, so to speak. But it was
Absolutely.
great discussion, Prabhakar. Lovely talking to you. We'll again do sometime a detailed discussion sometime soon. And maybe you and I can host Nuresh separately on a breath indicators.
Absolutely. Absolutely.
Right.
Absolutely.
All right, perfect. Thanks a lot. Thank
Thank
you
you
so
so much.
much.
Thank you, guys. Yeah. Thanks, Puneet. Thanks, Naresh. Yeah. Thanks.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.